Hi all, welcome to the session. Here we introduce you to the importance of budgeting and forecasting for your business. This is part 1 of our knowledge series where we share our thoughts on how to improve efficiency and profits in your business. I would like to start here with an example. Imagine you have 3 friends who are into contracting business or technology services business. They have been running business successfully for the last 3 years. For ease, we can call them RJ, MJ, and VJ. RJ runs his business just by observing his bank account. MJ has a budget which he follows, and VJ has developed forecast to guide his business. Now let's see how they react to various business circumstances like hiring, for example. RJ, as you know, runs his business with a gut feeling. His response: "My gut says let's do it." MJ's response: "I have a budget, let me check if it fits in." VJ's response: "Let me realign my forecast and see how this will impact revenue and cost and business overall." So what is MJ doing here exactly? As you saw, MJ is referring to a budget which is target oriented or goal oriented statement. It is generally detailed, a line item wise or department wise breakup of financial estimate. It is fixed at the beginning of the period, say beginning of the financial year. If you look at it in another way, he is just thinking whether the hiring will fit into his budget. That's it. As you can see here is an extract of a budget. It is an estimate of income and expenditure for a set period of time. Through a budget, he can allow or provide for a particular amount of money for a set purpose. So how is MJ better at managing his business compared to RJ? Some of the advantages that MJ has is that most of the times intuitive spending hurts profitability. MJ knows if he is overspending by setting a limit, so he has cost control. MJ has already budgeted for cost of growth, so he has better clarity and better growth strategy. Most of the businesses run out of cash just because of not monitoring the budget and spending at will, so cash management is important. As a business grows, MJ can delegate responsibilities to various departments. Budgets are a great way to monitor performance of each department and decentralize the control. So what is VJ doing? As you saw, VJ is referring to his forecast, which is similar to a budget. However, forecast is more dynamic, as it changes according to the current scenario and actuals on the go. It is driver based. For example, sales of a company may be directly related to number of salesperson they have. More the salesperson, more the sales. This is easy to track. MJ can devise multiple scenarios like best, most likely, and worst outcome and decide the way for his business. In other words, financial forecasts are a tool by which VJ can predict and meet his business goals more accurately. Here you can see in this extract of forecast, it basically is trying to predict MJ's future bank balance based on actuals till date and the projections for the following period. So now how is VJ better at managing his business compared to MJ? Some of the advantages that VJ has is that VJ can predict future cash balance in his bank account, maybe till the end of next financial year. This keeps him calm. VJ can simulate projections of multiple branches of his business and track performance. VJ can hire more and more people and fix key performance indicators and also manage them better. VJ can present his business to investors for raising capital or loans more convincingly. VJ can acquire a new business confidently. VJ can be going through periods of economic disruption, like for example the COVID-19 pandemic, but manage it in a better fashion. So many of you will have this question: what is the difference between budget and a financial forecast? The key difference between budget and a forecast is that budget is a plan for where a business wants to go, whereas a forecast is an indication of where it is actually heading. Budget is helpful for comparison with actual performance. Forecast can be used to take immediate action. Budget is rigid or static, whereas forecast is dynamic. So let's understand more about the types of forecasting that businesses can use. Rolling forecasts are a method of continuous planning. Like in our previous example, VJ includes 6 months of actual and 6 months of projections. So every quarter end, another 3 months of projection is added. This will make the forecasting process continuous and eliminates annual budgeting process. Driver-based forecasting is translating key operational activities into revenue or cost numbers instead of plain numbers that appear in your budget. This is done by using formulas like example, software sales is derived by multiplying average price and average enquiries or sales executives. Drivers are key activities which, if performed, will provide quantifiable results, like sales executives have to go out and convert sales inquiries. So review of a forecast. Not reviewing a forecast will make it redundant. Forecasts can be reviewed by the management either on a monthly, quarterly, once in 6 months or annual basis. However, we recommend to review at least every quarter. So now, to summarize the benefits of forecasting. It improves transparency and relationship with investors. It helps you to have a better control over your cash flow. It enables your business to be more agile and adapt easily. It also assists you to be in a better position to face uncertainty. In the next parts, we will show you how forecasts can actually work under various scenarios and how they help you to take better business decisions. Please provide your feedback or ask any questions in the comment section below. Thank you for watching.